We've got the spinny circle going, and it's time, folks. We're here for another money moves. Nutter. I don't know what that's about. Maybe we should have Nutter Butter. I love those little Nutter Butters, right? So maybe we should have them sponsor our show. I don't know. But anyway, we're here today to talk to you about something that's going to impact you one way or another. And it's fixed versus variable. Fixed versus variable. So fixed rate versus variable rate. Should you always choose one over the other? Is there time and place for one versus the other? But we're actually going to talk about that today. And as you can see, we're getting ready for St. Patty's Day. We're both wearing green. Glad to see you're in your green. That's awesome. I got my little Irish party pack on.
A little hunter green.
It's greenish. I got the feeling of it. So it's still good. I give you an A for effort on that. So folks, we're going to get ready to get started. Do me a favor, click that little subscribe button down there and the share button because this is something you want to know about, right? Fixed versus variable. We're going to talk about that in just a second. So we're back, and we're going to talk about rates, fixed versus variable rates of return, interest rates, call it what you will. What do you think? So before we get started, though, are you excited about St. Patty's Day coming up?
Of course, always. It's a great holiday. And it's on a Friday this year.
I know. It's going to be crazy fun. And plus the weather, I don't know, you're in Chattanooga, so I'm assuming it's even a little better for you. I mean, it's been great. Had some rain kind of mixed in there too, but the weather, you can tell spring is definitely here. Yes. I am so ready for it. Ready for baseball, ready for warm weather, ready to be out in the yard. I feel like I'm coming out of my, winter sloth. I got my, I need some sun. I need to kind of get back outside, breathe some fresh air, but I'm excited.
I don't know how people live where it's dreary all the time.
I don't know. Well, I lived in Chicago for a long time, and for those of you watching in Chicago, you get it, man. It's still cold, and it doesn't get really warm until May. You may have a day or two mixed in there, but yeah, it's like, man, the never-ending winter. But that's why I love it down south. But I'm going to tell you right now, if you're thinking about moving, go to Texas. Much better place. So anyway, so let's get started. We're talking fixed rate versus variable. I know we talked about this last week, Wendy. I mean, kind of, what are your thoughts on this? What were you talking about when you brought it up?
Yeah, well, I know that interest rates, speaking of interest rates, they're changing a lot right now, right? Oh, yeah. And they're going up. And so in talking about like getting out of debt, looking at what you have that's has the APR, tied to it, like that annual percentage rate or interest rates that can change, our variable rate debt specifically, we need to make a priority to like get rid of ASAP. And I was listening to something about, that variable versus fixed, and I had never thought about it before, but, fixed rate, like your mortgage, it's not going to change when everything else is changing and volatile in the marketplace. But it could get to the point where people that have credit cards and they're only making the minimum payments and then those interest rates increase, that you're like, you've got inflation going up and now the interest rates going up on those credit cards that you haven't been able to pay off. And now you're even worse position and can't even make minimum payments. So it's just a big thing to think about and to go, okay, I need to be getting rid of these high interest rate credit cards or loans like ASAP.
Yeah. And that's the truth. I mean, first of all, look to get rid of that consumer debt, if you will, the credit card, stuff like that. Don't carry that. Carry it, do it for the points, things like that. I know, the gurus out there say all debt is bad. And that's not true at all. And if you're disciplined, you can even use credit cards because you want to have your credit score and things like that. And, that's not what we're talking about today, but you want to keep that active. But you're right. I mean, those variable credit cards, the prime rate right now is creeping up and up and up, right? I think it's 7.5 right now. I'm not 100% sure on that. Excuse me. But just a few short months ago, it was half that, or less, right? And so it's one of those things that because you're on a variable credit card, variable credit cards, for example, are usually prime plus X, right? So when that prime rate goes up, HELOC loans, home equity lines of credits, same deal, right? And you can pay interest only on like those HELOCs in most cases, not all cases, but in most cases. But one of those, the problem with that is you're not actually paying the debt off.
Right.
You're just giving the bank your money and saying, okay, well, I'm not going to pay on the loan, but I'm just going to pay you the interest. And that's how the banks make money, right? That's why they call them banksters. They figured this out. So, you look at that and it's like, okay, well, how do I fix that? Well, first of all, you want to figure out the debt snowball, right? We've got tools, resources. Ping us below or reach out to us if you want those free tools to kind of help yourself get on a snowball. It works, and you can actually probably get out of debt a lot faster, spending the same amount of money you're spending on your minimum payments or what you're paying now, because usually people pay a little extra. But yeah, it's one of those variable credit cards are starting to really eat into people's budget. And then talk about the inflation that you just mentioned too. I mean, like you said, things are higher and my income's staying static. And so now I've got to not only, pay higher on the credit card balance I already have, but I may actually have to add more to that credit card in order to buy clothes, buy food, stuff like that, those essentials, fuel for my car. Because fuel prices, they've ticked down a little bit, but they're still way higher than they were 2 years ago. I don't know what changed 2 years ago. But anyway, it's one of those things that everything's going up and now people are financing it, and now the finance rates are going up. They're taking more and more of your money. So can you switch to a fixed rate credit card? There are credit cards out there that have fixed rates right now. Ideally you would have gotten that when the rates were lower, but better late than never, because guess what? That's where having that credit score, is something that you want to make sure you've got a good credit score. But I've got a credit card. I'm not going to say the bank, but it's a bank that everybody knows. And my interest rate on that credit card is 9.9%. I've had the card for, ever. I can't remember when I got it. It's been a few years, but I'm like, hey, do you have a fixed rate option? They're like, yep. And so my credit score was good. And so they said, sure, we'll give it to you. And I love it because it's like whenever situations I need, to pay for something with a credit card, and I don't like to carry a balance, but when I do, it's nice to know it's, still 9.9 is high compared to a loan, or at least it was a couple of years ago. It's one of those things that you want to shift when you have credit or you take out loans or you take out a mortgage. You don't want variable, right? You want fixed. Okay. So that's one of the things. Now I will be transparent. One of the first things I did when I bought my very first home, this is going back probably 2000. I took out what's called a 7-1 adjustable rate mortgage, meaning it was fixed for the first 7 years and then it was adjustable after that. Well, most mortgages refinance in less than 7 years. Either they do a cash out refinance, they sell the property because they need a bigger home or something like that. And so I got a lower rate because I took the 7-1 adjustable rate, but I knew it was going to be fixed and sure enough, it was. I ended up moving out of that house and, started a family. And then the next thing you know, we, bought a bigger home. And I kept that house, but before I left, I converted it over to a fixed rate mortgage and turned it into a rental property. But that's where when you're borrowing money, you want to have a fixed rate whenever possible. Does that make sense?
Yep, absolutely.
So let's look at the other side of the coin. What about when I'm growing money? Because you have a lot of people out there that are, touting, hey, get a guaranteed fixed rate of return forever and you never have to worry about it, right? Not a good deal when you're actually growing money, right? You want something there where it's more variable. If you want to add something to that or.
Yeah, no, it's funny because as I've had these conversations more in the last 2 years, never had these conversations before that, but a lot of people, we talked about a couple of weeks ago, permanent versus term insurance, right? Life insurance. And I know a lot of people use a certain type of permanent insurance for that fixed rate of return on their money. But yeah, like they're really getting gypped and a lot of times not even outpacing inflation right now, for sure right now. But I never knew until 2 years ago that you could get, like, I thought variable, it's volatile, right? Like looking at it originally, it was like, okay, well, I can have the ups and downs or I can have guaranteed. Guaranteed feels better, right? But then I learned about oh, you can have the upside without the downside. So
Yeah. Well,
everything
and that's a lot of what people, kind of look at too. They think on the variable side, on the borrowing, it's like, oh, I can afford the monthly payment. They don't realize that, okay, the more that interest rate goes up, your payment's going to go up more, that's going to interest. So they don't think about it. So you come over to the other side and they want that safety. I don't want to lose my money, but they're okay with, having more of their debt just get stacked up because of variable rates, right? So it's almost a kind of, again, we're not being taught this stuff in school, guys, which is so critical that you learn this stuff and you teach your children this stuff too. But on the fixed rate, on the debt side, I can plan my my monthly expenditures at that point. I know it's going to come out because it's the same cost, if you will, every month. On the other side, on the growth side, though, it's like, okay, well, yeah, I'm going to think of your savings account, right?
Mhm.
Horrible rate of return. Okay. Fixed index annuities, things like that. I'm not a big, or not fixed index, but fixed annuities, fixed rate annuities. I'm not a big fan of those because it's a fixed rate. And usually they're lower rates. Now you can get some with some nice little perks. Again, it's something you look at, but you got to make sure the person working with you is designing it properly. But going into the world of indexed and things like that, there are a lot of ways that you can get that up growth, but you can mitigate that volatility through hedges and things like that, where, like you said, Wendy, I get the growth, I don't have to worry about the downside, right?
Yeah.
So over time, you look at, okay, my account's going up, going up, going up. That's great. And if I never lose, then that's even better. I may have a year where I don't grow, but I stay static in my balance. And that way, when the market picks up, I can, pick up right where I left off, right?
Mhm. Yep.
And most people don't know that stuff's out there. So I'm glad you brought that up.
Yeah. And we talked to someone a couple weeks ago who was like, I wish I knew this 20 years ago. Right? Like,
Don't we all, right?
All the questions too. And I loved that because it's like, people have opinions about stuff in the finance world without knowing the full story all the time. And, it was awesome to sit and hear somebody like literally, she's like, okay, you've told me the good stuff. What's the bad stuff?
Mhm.
And we tell the bad stuff and like, well, crap, the good stuff far outweighs the bad stuff. And the bad stuff's not even really that bad. So let's do this.
Well,
anyway.
And that's the key. And whether you're working with somebody, and this lady was, working with an advisor from a very well-known firm, but they were telling her the one lane they wanted her to stay in. And, it has to do with how they earn their money and things like that. But, that's where you want to work with somebody who's going to educate you on everything. Right. And they're going to give you the pros and cons. Bust out the old Ben Franklin pros and cons, write a T on the paper and just start writing it out. But, going back to that fixed versus variable, what does fixed give you? Well, it gives you knowledge on what it's going to do today and knowledge on what it's going to do tomorrow, unless you're talking like, a rate of return with some kind of dividend attached to it. Whole life insurance does that. You got a lot of people out there pushing whole life, family bank kind of thing. But that dividend part is unknown, right? So it's a little bit of a both. But, you look at the fix, I know what's going to happen, but I also know what I'm not going to get. Your opportunity cost is higher on that, meaning you lose opportunity because you've chosen the fixed rate, right? You may have the safety, but okay, hey, I'm going to also give up some of the gain potential. Mm-hmm. So then you go to the variable, and the variable there is, well, I'm going to get higher gain opportunity, but I may have higher risk opportunity. That's where, wouldn't it be great if, going back to my Nutter Butters we were talking about earlier, like Tuck Reese's, if I could take that peanut butter and put it with chocolate and mix it up, boom, get the best of both worlds. And that's where you start talking about some of those index strategies and things like that. But, it goes back to, again, on the growth, I want variable. On the debt, I want fixed. Growth, I want variable. When I'm talking about my 401k, stuff like that, I want variable because I have a higher upside potential. And then I got to figure out a way to mitigate the loss part of it and also the tax part of it. And then on the fixed rate, I want that on my debt side. I think that's kind of a quick summary on.
Yeah, that was good.
Yeah.
So I like it.
It's the jacket. I'm telling you, it's the jacket. So, and I'm gonna just go ahead.
Go.
No, I'm just gonna state, my background, my family heritage is Irish, so this is like a big deal for us. And join me in my endeavor to make St. Patrick's Day a national holiday, where we actually get the day off. And St. Patrick's Day should always be, on a Thursday, and we get Friday off. So if you're with me on that, chime in below. St. Patty's Day, always we'll do it like Thanksgiving, third Thursday of the month, and then you always get Friday as a national holiday to recuperate, and then you got a 4-day or 3-day weekend.
I thought it was always on Thursdays. I don't know why I thought that. And then this year it's on Friday, and I'm like, wait, I thought it was always no, it's always the 17th.
Yeah, it rotates. It rotates. I used to have a crew when I was living in Indianapolis. We'd always go to this cool Irish bar and have our shepherd's pie, and it was pretty much we declared our national holiday and didn't work that day. So back in the day. But anyway, so everybody, hey, fixed versus variable. I want you to have a happy and safe St. Patrick's Day out there. And, educate yourself on money. Make 2023 your year you really break out financially. They're not teaching this stuff in school. And we want to make sure that you're learning this stuff and teach your children. Yes. If not, they're going to go all the pains and challenges you've had with money. If you don't teach your kids this, you're dooming them to repeat that for their own lives. So everybody have a great week. Wendy, have an awesome week. And we'll see you next Tuesday when we'll talk about some other money moves you can make. Bye, everybody.